Let's take a look at the top stocks for January 2025. Before we do that, because this is the first newsletter video, I'm going to go over my personal hierarchy for investing. First, no one is wrong. We're all at different places on our financial and investing journey, so don't be too hard on yourself. Everyone has different life expectations and risk tolerances. We are all at different stages in life, different circumstances, different ages. We have different strengths and weaknesses. We might come from different cultures or watched our parents manage money differently. We might have different income levels, family structures, or priorities in life. We all have our own hierarchy, but mine is being presented as informational to be adjusted for your own use and need. It's not intended to be personalized financial advice. If it's helpful, great. If not, fine. Before we get into the top stocks, first on the hierarchy, do you have the ability to invest? Do you have a safety net via either income or emergency savings, which is large enough that you will not need to draw on your long-term funds? I like to ask, are you debt-free except the house? If so, it might be time to think about investing for your future. Are there exceptions? Times when you might invest while still in debt? Sure, of course. Debt-free except the house is my recommendation. But if you're being offered a 401k match, always take the max 401k match if you're offered, and you want to get your foot in the door at small amounts, or if your debt is at a really low interest rate, or if you're already wealthy and you're using debt to, say, avoid income tax by not taking a salary and borrowing against it. All this to say, there are exceptions, but if you're really wealthy, this portion of the hierarchy really doesn't apply to you. If you're not wealthy, I recommend having an emergency fund in place before putting your money at risk in an investment like the stock market. Number 2 on the hierarchy, for most people, use investments, not cash, for all long-term money. No cash-like items like CDs, unless it's part of your emergency fund, or projected spending within the next 5 years. Yes, some people need larger emergency funds. Yes, you might need cash for spending before retirement, like home repairs, paying for your kids' college, vacations, your life, etc. If your only source of income is a paycheck and you don't have a lot saved up already, you probably don't want to invest money you will definitely need in the short term. This is said with the caveat that if you do already have significant savings or are in fact in a financial position which allows you to invest earlier rather than later, odds are in your favor to invest as early as possible. Yes, short-term downturns happen in the stock market, but unless you foresee needing to draw a significant amount on your investments in the short term for life needs, odds are in your favor to invest now compared to later. Number 3 on the hierarchy, what to invest in then? I have a hierarchy for that as well. Mostly, I want to get the point across that investments like stock and real estate perform the best over the long term compared to cash. Huge gap after that, followed by high interest savings, CDs, bonds, possibly commodities like gold or crypto, maybe. Then another huge gap, followed by the big 3. Your company's 401k/403b, followed by your local financial advisor, and then, by far, in my opinion, doing it yourself. Low-cost ETFs in a diversified portfolio, which you manage in your own retirement or brokerage account, or even, number 1, in my opinion, a combination of stocks that you selectively choose and low-cost ETFs in a diversified portfolio, which you manage in your own retirement or brokerage account. And possibly even better, what's the best income number 1 wealth generator in the US, starting your own business, or combine it with real estate purchases, which offers a nice diversification to buying stocks. Now, many people believe that the way to go is just to own only ETFs, low cost, that's the way to go. Honestly, for most people, that is 100% true. But let's try and do better. Let's see if we can do better than a VOO, VTI, the big diversified ETFs out there. Can we select the best stocks? Can we tell which stocks are the best? I think we can. Let's do it. Let's get to our newsletter for January 2025. Our number one top pick is MercadoLibre, Meli, ticker symbol MELI, an extremely well-run e-commerce giant in South America, often called the Amazon of South America. They do online retail, fintech. The sector is consumer cyclical. Extremely profitable despite a inflationary environment, which you probably know about in South America. So despite the inflationary environment growing at 34% projected for 2025, their growth for gross margins for 2025 expected to be 52%, 7.7 net income margin, so incredibly profitable. Forward revenue is 21%, below the 5-year average growth rate, which has been 43%. Can you imagine that? Its market cap is $86 billion, and it's grown at 43% on average over the past 5 years. So yes, it is growing at a slightly slower pace than it has, but boy, has it improved profitability. Total stock return over the past 10 years, 1,388%. I mean, there's well-known risks in South America, but just growing like crazy, profitable. Stock has been incredible. Recent price dip, MercadoLibre, our number one stock pick for 2000. The number two pick for January 2025 is Cellebrite, CLBT, market cap of 4.81 billion, so it's a small cap stock. Intelligence data for law enforcement is what they do. CLBT provides forensic and intelligence data and software to U.S. agencies and law enforcement worldwide, including Europe and in the Middle East. It has home run potential, in our opinion, but is not profitable on a net income basis. As such, caution is advised for investors without a robust, diversified portfolio. We really like our odds with this pick over a 5 and 10 year time frame, so long as management continues to execute on their goals, which, to be honest, over the past 5 years, they certainly have, with an average revenue growth rate of 16.4%. We like to call it the next axon. CLBT is scalable and growing, as UFED software has achieved nearly 100% adoption rate in U.S. agencies and has plans to rapidly expand into new markets. With the increased need for data, especially in law enforcement, we see CLBT to be similar to Axon, where agencies around the world need access to the technology. UFED is subscription-based and recurring. Hallelujah. Forward, a free cash flow growth rate of 93%, which is 641% better than their sector, which is information technology, with a valuation of about 44 times cash flow, which is about 110% higher than the sector. So it's, growing its cash flow at an insanely fast pace, but it's also valued fairly expensively. If you want to compare another stock, ServiceNow trading at somewhere around 46 times forward cash flow, so pretty close to another high growth stock out there. So not high, but not extreme. Return on common equity is actually negative 82%, not something we are looking to actually typically recommend, but this particular small cap has a lot of potential, a lot of potential for growth in their market, and 100% adoption rate. I mean, if they're putting it out there, it's being purchased. So we think we're going to maintain a buy rating, a strong buy rating on this stock. Elevated risk, but strong buy. Number three on our top stocks for January 2025 is Lantheus Holdings, LNTH, market cap 6.22 billion. Sector is healthcare. The primary business is healthcare supplies such as imaging enhancement for ultrasound and Alzheimer's diagnostics. This company has two mature products with double-digit growth in Clarify and Definity, with dominant 80% market share in Definity. Clarify is a cash cow, generating over $1 billion per year in sales and is projected to reach $2.5 billion in sales by 2030. They already have one high growth product in Technolite, growing at over 30% per year. Strategic spending in the Alzheimer's market, with two products in testing, MK-6240 and NAV-4694. Although it's a biotech, and biotech is extremely competitive as an industry and inherently risky. Lantheus's already profitable products give it a safer floor than other stocks, and it trades at a very reasonable price to cash flow of about 13.2, about 23% below industry, while expecting 19.5% revenue growth in 2025, which is 155% above industry, all while operating with 64% gross margins, 28% net margins. This company is so profitable. They are located in Bedford, Massachusetts. In the Alzheimer's market, it's growing. It's fast growing. This is a company it's a small market cap, but that's the kind of stock you want to pick if you want to go a little bit higher risk. I'm not betting the farm on it, but boy, do I want this stock. The number 4 stock for January 2025, AppFolio, APPF, market cap of 8.86 billion. Information technology, their primary business. They provide cloud software for the real estate industry, allowing automation for leasing, maintenance, and accounting. APPF offers a complete solution in the real estate industry, covering property managers, residents, and real estate investors. Single-family ownership is declining, adding tailwinds to rental markets around the U.S., which we expect to continue. With a strong track record and high profitability in an expanding market, we rate APPF a buy. Their revenue forward is 25%, which is 366 higher than sector average. Their 5-year average revenue growth rate is 23%. Forward operating cash flow, 115%, which is 755% higher than their sector, showing huge pricing power and profitability. Return on common equity of 39%, which we love to see. We love to see the high return on common equity. They've consistent gains, consistent returns over the past several years. Total return of the past 1 year, 44%. Total return over the past 5 years, 107%. We're talking about stock equity gains for shareholders. Total return over the past 10 years, 1,693%. Yes, please. Our number 5 stock for January of 2025 is Taiwan Semiconductor Manufacturing Company, TSM, otherwise also called TSMC. They're in the information technology sector. Obviously, they are a semiconductor fabricator, as you probably know. Very big NVIDIA partner in the growing AI sector. TSM manufactures, tests, packages, and sells integrated circuits and other semiconductor devices. They also offer wafer fabrication as well as customer engineering and support services. TSM is an incredibly profitable company with dominant market share as the world's top semiconductor chip foundry. As the world becomes more digitalized, TSM stands to benefit from new technologies such as AI, self-driving, robotics, quantum, and basically every advancement that needs the best specialized chips in the world. TSM has engineers and the know-how, trades at a reasonable price, and their stock has a decent chance to honestly crush the market over the next decade, despite its size of $849.96 billion as of January 2nd. Due to their market cap of $850 billion and close partnership with NVIDIA, they have amassed 62% market share in the semiconductor chip manufacturing industry, which is estimated to expand to north of 66% by the end of 2025. Their valuation is depressed on a price to cash flow basis, as well as forward PE and PEG compared to NVIDIA, as well as other semiconductor stocks, possibly due to geopolitical concerns surrounding China's rhetoric regarding potential invasion of Taiwan, or potentially due to the possible AI, let's say it went into a downturn, something like that. It has been on a tear recently. Concerned? Not really. Despite total returns of 110% in 1 year, 295% in 5 years, and 2,000%. That's equity returns for you stock shareholders out there. 2,000% in the past 10 years. TSM stock trades at a forward price to cash flow ratio of 18.65, quite a bit lower than other growth stocks out there, which is 12% below the information technology sector as a whole on average, with management projections for 2025 revenue exceeding the sector by 150% and EPS exceeding the sector by 40%. This while net income margins exceed 39%, 900% better than sector average. This is an incredibly successful and profitable company that dominates their market, and as the world becomes more digital, stands to grow for a long, long time. ladies and gentlemen, DSM's buy. Here's a little bit about our methodology for stock selection. We aim to identify the best companies in the world and believe that buying them consistently over time produces the best long-term results. Our top 5 and top 20 will reflect this, but also with consideration for value at the time of newsletter issuance in order to produce the best long-term CAGR and remove some short-term risk. We believe that purchasing equity in the best companies in the world is an unprecedented opportunity historically, and that they can and should be purchased over and over again within a diversified portfolio in tandem with low-cost ETFs. Although these are the stocks we are buying now, they may not be the largest positions in our portfolio. Our entire portfolio is available for purchase or for free with a Patreon membership purchase. Risk profile. We have chosen stocks in our top 5 which we believe have a strong chance of outperforming the market over the next 5 to 10 years. With this in mind, we have made an effort to include stocks with lower market caps in order to maximize long-term growth potential. Most investors should not buy individual stocks, but use our lists to learn more about the market or for investment ideas. Buying our list each month would be risky and is not our recommendation. We see it as an educational tool. Here are the basic rules. In selecting our top 5 stocks, we will only select from a pool of equities which are tradable in U.S. retail portfolios, either by trading on the U.S. stock exchange like the NYSE, NASDAQ, or available via ADR for U.S. traders. Our top 5 will never include bonds, CLOs, commodities, crypto, mutual funds, ETF, or cash. Our core beliefs. We believe that most investors should buy low-cost index funds or use a financial advisor, but that a selective portfolio of individual stocks in tandem with ETFs can and hopefully will outperform in the long run for smart investors. Our investment time horizon. We hope 5 years minimum is what we're looking at. Our favorite holding period, of course, forever. They're the best companies out there. We want to hold them for the rest of our lives as long as they are producing adequately, and we hope they will. Additional disclosure, this newsletter is not personalized investment advice and is not intended to be. The stocks written about in this newsletter may be owned by the writer or members of the writing staff. The above articles, including our top 5 and top 20 lists, should not be seen as individual investment advice or an offer to buy or sell a stock. This newsletter is for informational purposes only. The opinions expressed should be examined thoroughly and are not taken as fact. The information provided is based on current market conditions and may change without notice. Past performance is not indicative of future results, and investors should conduct their own research before making any investment decisions. Before making any investment decisions, please consult with a qualified financial advisor to consider your individual circumstances and risk tolerance. No public company has paid the writers for the articles above. They are opinions, not advertisements. They do not reflect the opinion of YouTube, Patreon, Twitter, Facebook, Instagram, or any public company within. And just to be clear, I do know it's February and this is our January list, because if you subscribe to our Patreon account, you will have access to these stock picks 1 month ahead.